Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, I'm joined with my good friend Keith Weinhold. How you doing today, Keith?
Hey, fantastic. Thanks for having me, Kirk.
Yeah, well, I brought Keith on. Keith was nice enough to bring me on a show about 6 years ago. He's got a great podcast, Get Rich Education. Had a lot of fun in his show, and finally, after 6 years, I decided to invite him on my show. So a little late in the uptake, but wanted to bring him on. Keith's really sharp podcaster, and I think we're gonna have a great conversation today. So Keith, tell us a little bit about your background and what you do.
I am an active real estate investor. That's how it begins. For me, it began with making my first ever home a fourplex building in Midtown Anchorage, Alaska, of all places, because I learned I could buy that building with just a 3.5% down payment if I lived in one of the units for at least 12 months. So that's what I did. I lived in one unit, rented out the other three, learned real estate investing that way, and grew from there. And this is something super actionable for your audience already, Kirk. One can still get an FHA loan with a 3.5% down payment for either a single family home, duplex, triplex, or fourplex, as long as you live in one of the units for 12 months, have a minimum credit score of 580. I think most people have that. The higher your credit score, the lower your interest rate. But that's how I began. And then I expanded to multiple states, really without adding much more of my own money, Kirk, by doing cash out refinances of accumulated equity in properties and 1031 exchanges, a way so that I don't have to pay any capital gains tax as the value of my properties grow. So I'm actually taking on more debt. And really, a principle that drove me is financially free beats debt free. As I grow my portfolio nationally, and have even grown it internationally, I want to take on more debt. Debt is good in real estate when you can completely outsource it to tenants. I know some people have an aversion to debt, but being driven by financially free beats debt free help me expand rather than keeping a small portfolio and trying to get them paid off. And you touched on it. For years now, I've been helping other people do that through the Get Rich Education podcast.
So why'd you decide to start the podcast? I mean, you have a great show. Why do the podcast if you're a real estate investor?
Yeah, why do it? I think it's to have a sense of meaning in life. And I don't want to get too touchy-feely here, but my wife and I don't have children. I want someone to pass along the lessons I've learned to. And I used to work a day job for a state Department of Transportation, cubicle dwelling, Excel spreadsheet using day job worker. And what happened is a lot of coworkers began to realize that, oh, well, like Keith is going and vacationing in Hawaii again, or even vacationing in Asia again. We're not living this type of life. We know how much money Keith makes at work. What else is he doing? So that's how I got talking about real estate. And I got used to talking about it to my coworkers because they would often ask me how I'm doing this. And that made it very natural to get on a microphone. And rather than talking to people one-on-one, when I used to have a day job, I've since quit my day job because I have residual income from real estate investing. That's how that natural progression came along. But you know what, Kirk? The interesting thing, all those former coworkers I had at the DOT, most of them just kind of nodded their head and think it's interesting that I'm building residual income streams, but they didn't actually act. Most people don't actually do anything with this information.
Yeah, it's interesting. I think that's very common. People are, when it comes to the entrepreneurs, people call them wantrepreneurs.
Yeah.
Like they're really interested in the idea of starting a business, but actually starting a business is a little bit too far of a stretch. So I totally understand that. So, you've interviewed a lot of people, you've done a lot of podcasts. Like, what are some of the best lessons you've learned from interviewing others or just getting different perspectives?
It's allowed me to be a better listener, and it's made me, help realize that, just because of the way I view the world, it's not necessarily the way that other people view the world. And, a lot of times it's not about who's correct. A lot of people come on shows, especially a lot of doom and gloom people, and they can make incorrect predictions all day, like like we should have had, 7 Great Depressions in the last 10 years, according to a lot of people. An interesting thing I've learned from interviewing so many people, Kirk, is some of the more popular people have these gloom and doom predictions. They're completely wrong, yet people continue to listen to them. And I think that's because they speak in a compelling way where they really sound sure of themselves. So it's kind of too bad that it is that way sometimes. Sometimes it's not about who is correct, it's who sounds convincing. And I think that's actually a little bit unfortunate. That's one thing I learned that I did not expect to learn, Kirk.
Yeah, I've noticed the same thing. There are many people who are compelling speakers and influencers, and when it comes down to the meat and potatoes, it's not always there. But it sounds compelling, right? Like all these newsletter writers are like, "Oh, you should buy this," and they attach a great story to it. And the story is what ends up selling people because it's like, "Oh, what a great story! I love this stock," and they don't know why they love the stock is because of the story, right? And I mean, I think that's why a lot of people like long form content because the conversations, the stories, right? What's one of the craziest things you've interacted with a guest, like one of the craziest stories you've heard?
Yeah, I don't want to name any names, but there's certain high profile guests that I just don't invite back. And it's things like the stock market is certain to fall 80% by the end of next year. I mean, come on, whatever you try to say to validate that with, like, that is so extremely unlikely. That didn't happen in 1987. I mean, did that even happen in the Great Depression? So that's one like very specific, actionable thing. But as we know, like just kind of from the old media mantra, if it bleeds, it leads. People really like bad news. They want to hear bad news. That's what's on the NBC nightly news. And it goes really back to this primordial instinct of one's amygdala, which is the fear producing part of the brain, often dominating the cortex, the front part of the brain. And the cortex is what regulates logic. Now, the amygdala at the top of the brainstem, really something primordially that helped early humans from being eaten by the saber-toothed tiger. That's very powerful. People really lead into fear. People are often more concerned with protecting themselves from loss than they are seeking out gain. It's kind of too bad that it is that way, but that's the reality of it.
Yeah, fear and greed. That's what runs
Right.
investing, right? Wall Street, it's all about fear and greed. If you're either selling one or the other, FOMO or the sky's falling, whatever it is, it's one of the two. So by the way, what kind of real estate do you invest in?
Residential, always have from the beginning. And Kirk, I don't invest principally for appreciation. I never have. I invest principally for cash flow. I'm not sure if all of your listeners know what that means, but generally what that means is the monthly rent income should exceed all of the monthly expenses. And all the monthly expenses are your mortgage and your operating expenses. And a great acronym to remember what your operating expenses are is VIMTOM: vacancy, insurance, maintenance, taxes, utilities, and management. Those are your expenses. And yes, that last one, management, is important because that's what keeps this relatively passive for me. So I can typically find properties where, with a 20 to 25% down payment, single family homes up to fourplexes, sometimes larger apartment buildings, I can have my rent income exceed the mortgage and those VIMTOM expenses. So that's principally what I invest for. And I'm being quite literal when I use the term investing, because this is not very speculative. If on the day I buy, the rent income exceeds all those expenses, that's my residual income stream. So that's what I invest for. And typically, the best regions for this in the United States tend to be in the Midwest, the Southeast, and in the inland Northeast. Not so much the coastal Northeast, but the inland Northeast. So that's what my investor life looks like. I own residential properties in multiple states. I have managers in those states, and I just have the manager in each of those markets email me one monthly statement with my income and expenses, and then a direct electronically deposited income into my account. That's how I invest, where I invest, and why I do it.
Nice. So you bring up a lot of interesting points. Now, are you still working at the DOT or are you kind of independent now?
Oh, no, no. I left my day job about 7 years ago.
Nice. Nice. That's awesome. So you own properties in multi-states, and this kind of brings up a few different questions. One of which is, um, A, how do you manage properties in multiple states, right? And you're not there to see it. Um, and then the other way is it really make sense to have them in multiple states? Like, why not just have them in one place and you could aggregate the costs and kind of reduce your costs by keeping it in one area?
Yeah, that's a great question. I don't want to invest in only one geographic market because, of course, oftentimes we talk about real estate, we put it in this box where we talk nationally, but we know that real estate's a rather local and regional phenomenon in location, location, location. So if I'm in only one market, I feel like I'm not very well diversified. I could be subject to the whims and fortunes of that particular MSA, metropolitan statistical areas, economic fortunes and misfortunes. And I like to invest in the larger metros. There is more risk with investing in some little outlying hodunk town of 8,000 people, where one third of that town's employment is tied to, say, the tungsten mine. All right, well, if I own rental property there, I've got to have rent paying tenants in it. And now my fortunes are much too tied to the tungsten market, a market I may or may not even understand very well. Or another common problem is that people put all their eggs in one basket in, say, a military town. Okay, military deployments can be quite volatile based on one's presidential administration and everything else. So I try to avoid those type of situations where I'm invested in, say, an MSA that has all their eggs in one commodity basket, or maybe all their eggs in a military basket. And I want to be in multiple metros that have a good diversification of economic sectors, especially things like technology and medical, where there's job growth there. You typically find job growth in those MSAs, because buying long-term real estate and holding it for the production of rent income, I somewhat get married to that market. I'm probably going to be invested there 6 or 8 years or so. So when I say buy a new property in Memphis, say I buy a duplex in Memphis and say that's my next purchase, that's exactly the type of place where I like to buy. I need to have a long-term vision and think, okay, well, I'm not buying it so much for the two tenants that are in that duplex right now. I'm buying it so that in, say, 18 months, one of those tenants leaves. I have a reasonable expectation that another tenant is going to have a job and be able to come in and pay the rent. So, this is about having strategic vision in multiple markets and being well diversified, because I get married to each region's economy. But, Kirk, oftentimes I have never seen the property in person before I buy it. Oftentimes, I have bought a property 1,000 miles away, owned it for 8 years, sold it for a profit, and held it for the production of cash flow. And there are certain ways to do that with using technology today that give me a high degree of confidence in buying just that way, especially when I find I have a good communicative property manager in a market. I want to put more things into their portfolio.
You must be a magician because I haven't talked to many people who can find good property managers. So how do you do that? Like,
Oh, it
how
is
do you?
hard.
Yeah, yeah,
Well, you,
yeah.
you you bring up a good point. Property management is the glue that makes this investment stick together. I network and I get referrals through friends. The Bigger Pockets forums, biggerpockets.com, oftentimes you can get great recommendations on property managers there. But property management is such a tough business and it's difficult to find a good manager. And that's really for one big reason. The property manager has to serve two masters. They're trying to serve the tenant and they're trying to serve me, the investor owner in this case. And oftentimes those interests are antagonistic. So, yeah, I've got to admit, when I find a property manager, Kirk, that's simply adequate, then that is good enough.
Yeah. I mean, so how much do you rely on them? You said you haven't seen some of these properties. I mean, are you only buying properties that are ready to go or some that need some work, or how do you figure?
That's another really astute question, Kirk. I buy properties that are turnkey. For those that don't know what turnkey real estate investing means, that term had its advent about 20 years ago. And what a turnkey real estate investment is really three things. It means I'm buying a property that's completely renovated, which means I'm really buying someone else's at scale fix and flip, or it's a new build property. The second thing is it is already tenanted for me on the day that I buy. And then thirdly, it's held under management for me from day one, if I so choose. Some choose to manage remotely. I don't choose to do that, but that's what a turnkey property is. And that's how I buy. It's newer renovated, it has a tenant in it, and it is under management. And turnkey real estate investment companies, they really offer all three of those services in house. That's how I like to buy.
Nice. So if you're looking at different markets or, different properties, I imagine, you mentioned looking for areas that is job growth, which I think is great. What are some other metrics you're looking at to determine whether it's a good property or a good price?
Really, the base metric that I look for is what has a high rent income in proportion to a low purchase price. So, to make it really easy, for every 100K in purchase price, if I get $800 of monthly rent, okay, that ratio is about 0.8%. $800 of monthly rent for every 100K in purchase price. That's kind of a favorable top line ratio. That's kind of the ratio. If it produces that much rent or more, that is going to create a residual income stream for me. So, just real generally, that's what I look at for numbers. And then I also like to buy in a state that has advantageous landlord tenant laws, laws that tend to favor landlords more than tenants. For example, in a lot of these states that I buy in the Midwest and Southeast, you can get a prompt eviction for a non-paying tenant. You can get an eviction in 30 days or less, where just generally on the coasts, laws favor the tenant. What do they call them in California? Professional tenants, where they know how to not pay the rent for 18 months and be able to yet not be evicted. I want to avoid those situations. And that's why I invest more in the heartland in the Southeast, Kirk.
Yeah, you raise a great point. Massachusetts is one of those states. It's terrible, terrible for landlords. But then you go to Rhode Island, they kick them out in 30 days. You don't pay your rent. 30 days, you're on the curb. The constable takes your stuff, puts it on the curb, and you're out. Massachusetts is one of those professional tenant states. It takes 9 months at the very earliest, probably 18 months to 24 months is probably more realistic unless you're a little creative. Yeah, it's tough. I totally hear you on that. So, all right. So you look for that. That's great. But, I'm looking at some metrics right now, and you see there's certain parts of the country that are just unattractive, right? If you look at, the house price compared to median income, pretty much the coasts, all the whole West Coast, and the heartland's pretty good. And then you look at the East Coast along the oceans is pretty bad. So even Florida, I mean, Florida is not great. Some areas are, but so how do you square that when hypothetically everything's overvalued? What would you prefer? Would you prefer to stay in an area like Florida that's overvalued, or would you prefer to go to a place like, I don't know, Kentucky or Tennessee or somewhere like that, where there's actually a lot more affordable home prices that are affordable? I mean, the numbers look sweeter in terms of your returns.
Yeah, that's a great question. It's interesting you bring up Florida. In the past 5 years, that's where I bought more property than any other state. But yes, in the past 2 years, Florida has become really pricey. And that's forced me to look more into inland markets like Chattanooga, Tennessee, Little Rock, Arkansas, or the aforementioned Memphis, Tennessee, or Cincinnati and Dayton, Ohio, where you have high proportions of rent income to a relatively low purchase price. So, yeah, with what's happened recently and there being more pandemic migration to Florida, running up the prices there, As I talked about, I don't buy so much for appreciation because appreciation is speculative. I buy for cash flow. So that's brought me inland somewhat with what's happened in the past 2 to 3 years with the frenetic real estate price run up.
Yeah, I appreciate the fact you said you buy for cash flow, not appreciation. That's kind of a rule number one we tell people is you're buying for cash flow. You don't know what appreciation is going to be. That's a guess. Cash flow, you know what it is, more or less. Um,
Yeah, yeah, that's right. The things that we teach here at Get Rich Education are that real estate pays 5 ways simultaneously over the long term. In fact, I wouldn't buy a property if I didn't expect 5 profit sources. The first is appreciation. You can't count on that in the short term, but you likely can in the long term. The second is cash flow. The third, which is also not speculative again, is the ROA, the return on amortization, because your tenant pays down part of your principal for you. That's an advantage that you don't have in your primary residence, because in your primary residence, you have to pay down the principal with money from your own pocket. And then the fourth of 5 ways is the very generous basket of tax benefits, which gets really nuanced to get into. That's also not speculative. And then the fifth and final profit center from real estate investing with a down payment in turnkey property, like I'm talking about here, is an inflation profiting benefit from the long term fixed interest rate debt that you get. So, for example, in inflation, not just hedging, but inflation profiting benefit, an example is if you take a 100K loan with 5% inflation, you only owe the bank back 95K after year one in inflation adjusted terms and 90K after year two in inflation adjusted terms. And again, your tenant's making the interest payment for you. So it's a phantom like fifth benefit when you take out a loan, even with higher interest rates. I want to be a borrower more so than a lender.
yeah, no, I agree with you when we have high inflation, but what if you have deflation, which I would say most people would discount because it hasn't happened in the last 65 years. But I would say, given what's going on now, it's highly possible we could even hit negative inflation by the end of the year.
Some think so. I mean, we know that the long, like you alluded to, we think that the long-term trend is inflation. We know that the Fed targets inflation. There just aren't a whole lot of things where you can almost make a sure bet for the future, but it's been a pretty good bet for the last 100 plus years, ever since the creation of the Fed in the 1913, that the forces are inflationary more so than deflationary. Of course, deflation is bad for the borrower, inflation is good. And I think one thing that a lot of prospective borrowers don't consider, Kirk, is that who's the biggest debtor nation in the history of the world? It's the United States. We have about 32 to 33 trillion dollars in debt. So we want to have an inflationary mandate. It makes it easier for us to pay back our debtors when we have inflation. If we owe China $8 trillion, what's the easiest way to pay them back? Print more currency. So we're kind of aligning our interests with what the Fed and the government wants to do in order to debase their debt, just like inflation debases our good real estate debt while the tenant pays it down for us. So I'm more of an advocate that we're probably going to have more inflation than deflation, but yeah, deflation is always a possibility.
Yeah, no, I just raise it because it's certainly a lower probability outcome, but
Yeah.
I think if you look at Japan, I mean Japan had it, right? They've had it for 30 years, and I think the concern that I would have is if it lasts. I don't think it will. I think the Federal Reserve has a lot of ways they can kickstart that, but still, it's definitely a real issue to think about. And I'm only bringing it up not because it's highly probable, because I'm not claiming the sky's fallen, but I think people need to understand how it works, so they understand that it's possible, which means you understand how it works. You're not just taking for granted that it's inflation to the moon and we never think about it again, because that's how Wall Street blows up, right? 2008 was because people made assumptions that weren't true. Real estate always goes up. Well, it's not true. It doesn't always go up, but it tends to go up, the trend. But when the assumption was wrong, all of a sudden everything blows up. So that's the only reason I bring it up.
Yeah, that's right. And in 2008, and by the way, I've invested through two recessions, including through 2008, still buying property, even though property prices got suppressed. In fact, I bought another fourplex building in 2007. I bought it for $530,000. The value at its low fell to about 480, not as much as it did in some markets. That didn't feel very good. And when it's down at 480, you don't know how low it's going to go either. That was my first experience with this sort of thing. But yes, the thing that saved me is cash flow. I continue to have the rent income on a national basis. Rents hardly went down even during the global financial crisis. Part of that is because people couldn't get a loan to buy a home, so they had to become a renter. But my point is I still had rent income that exceeded the mortgage payment and all those VIM-TOM operating expenses. So during the global financial crisis, I was fine because I bought for, again, yeah, cash flow, not appreciation.
Yeah, that's great. So let's dive into some interesting topics here because obviously you've been in real estate for a while and you have some pretty strong opinions about this, especially from interviewing other guests. Um, you know, I think a lot of people are confused right now about all markets. Inflation went from pretty much close to 2%, zero, whatever you want to think about it, up to 5% or up to close to 10%. Depending who you talk to, they think it's higher. But, the CPI went up to 8 something, 9%. And, now it's dropping. Now it's 3. My prediction is we could hit zero by the end of the year. It's not highly probable, but where I'm getting at is how does real estate handle this, right? Because I think the dynamics of the markets have changed with this new paradigm shift we have going on in the world. And so why is real estate resilient and not come down yet? Because the cash flows don't seem to line up with higher rates.
Yeah, I think what you're getting at is, well, mortgage interest rates doubled last year. How is real estate resilient? How is it hanging on? We've had some price attrition in West Coast markets, but on a national basis, real estate prices have remained stable and even beginning to increase here this summer on a national basis. It's hard for people to square that up with higher mortgage interest rates. And, I've got to share something with your audience here, Kirk. People are not going to believe it when they hear this from me the first time. And I sent you a chart the other day to back up what I'm saying here. When mortgage rates rise, expect home prices to rise, not fall. And that throws most people so far off. They're like, well, wait a second. Don't you know that when mortgage rates rise, that decreases what people can afford? And wouldn't prices have to come down? Well, what kind of world does this happen in? Maybe you're wondering what happens in the world that we've been living in. In 2021, home prices rose 20% nationally. And in 2022, home prices rose another 10%. What happened during that time? Interest rates soared from about 3% to 7% on a 30-year fixed rate owner occupied loan. And this throws a lot of people off, but this is what usually happens when you have higher mortgage rates. You typically have higher prices. And if you're still wondering why and how that could possibly be, first of all, I think it's easy to have a hunch about something. When we go ahead and apply economics to real estate, it's easy to have a hunch that higher mortgage rates would mean lower prices. But what I often like to say, Kirk, is my theme is history over hunches when we apply economics to real estate. It was Winston Churchill that said, the further you look into the past, the further you can see into the future. All right, so let's look at history. What's happened in the past? For about the last 30 years, since 1994, interest rates have rose significantly 9 different times. That's defined as a mortgage rate increase of 1% or more. And of those 9 times, real estate prices rose 7 times. And I can see you're putting the chart up there on the screen right now, that this typically happens when mortgage rates rise, home prices rise. Now, when I talk to PhD economists, for example, on my show, they understand this. They're not surprised by this, but actually a lot of the real estate people are the ones that are thrown off by this. All right, well, why does this happen? Well, first of all, changes in the economy, they take some time. There's some lag effects until things work their way through the economy. But this can't completely be described by lag effects because when mortgage rates rise, most other interest rates rise as well. And why is the Fed increasing rates? We have to think about why they do that. The Fed increases rates when the economy is hot and people are employed. And right now, we're still in a period where there are more open job positions, 1.5 to 1.8 open job positions, than there are every available worker. Well, that's inflationary because employers are competing to pay workers more. Finally, now we have wages higher than inflation. But this is what typically happens. The Fed has to cool off the economy because all these people have jobs and have options. Americans are flush with cash right now. When Americans are flush with cash or they're secure in their job, what are people likely to do when they're really secure in their job and they have a lot of options? Buy a home. So it's one's income and one's personal situation that has more to do with their decision and that family's decision to buy a home than what mortgage interest rates do. Mortgage interest rates matter, but it's not the primary driver of buying a primary residence for oneself. So again, completely paradoxical and counterintuitive to a lot of people. Typically, when mortgage rates rise, home prices rise. Like I said, it's happened 7 of the last 9 times, which is a stretch of over 30 years. And Kirk, the only 2 times that home prices didn't rise when mortgage rates rose, that was in 2007 and 2008, as demonstrated on the chart that we shared there. And there were all kinds of weird aberrations in the housing market in 2007 and 2008, including like liar loans and an oversupply of housing, where now we have an undersupply of housing.
Yeah, I would agree that 2007, 2008 are a little bit outliers. Actually, what I would love to see, because we talk a lot in the show about how people use numbers to tell a story, and it's usually it's the story that they want you to hear. And I'm not suggesting you're doing that, but I bring this as an example because the chart that I get see thrown around a lot is, wow, rates have gone up the fastest in any time in recent history. I'm like, what about the 70s? They're like, well, that's not recent history. I'm like, what better example to look at? That was much faster. I think they went up 11% in 1 year. So, and people don't want to show that because that doesn't tell their story. But what I would be curious about is how the numbers look in the 70s, because the 70s actually had big rises in interest rates and inflation. Whereas if you look back in the last 30 years, it's a lot more gradual. And I totally agree with your points. I think you've caused me to look at things a little bit differently, because I think if you're gradually rising it, agreed, right? Things are getting better. Look at the late 90s. They kept raising rates and everyone was angry at Greenspan because he's raising rates. Like, what are you doing? You're going to kill the market. And he's like, that's the point. Like, it's too hot. And it did, right? And then of course they had the real estate bubble, which blew up. But I would be curious if you've ever looked at those numbers, because that was a lot more rapid, and that's the rapidity of the change is actually what's interesting more than the actual increase.
Yeah, that's a good point. We had such a rapid increase in interest rates in 2022. I mean, they climbed a cliff when you look at a chart. And when we look back at the high inflation, high interest rate era of the late 70s and early 80s, and by the way, the 30-year fixed rate, it peaked at 18.5% in October of 1981, which seems incomprehensible to some people. That's when we had a very aggressive Fed chair named Paul Volcker that was just driven to do whatever it took to hammer inflation, and we sure did. We had pretty stable home prices then, even rising a little. But of course, with that, and with this entire conversation that I just had about what's happened with home prices the past few years, we need to think about nominal dollars versus inflation adjusted dollars. Because when you have high inflation, a $300,000 home a couple years ago is not the same as a $300,000 home today when you're comparing inflation adjusted dollars versus nominal dollars. Nominal means in name only. So really the overall takeaway is that mortgage rates just don't have as much to do with home prices as what most people think. So we've talked about the past, we've talked about the present. A lot of people like to know where we're going in the future. And this whole talk about a recession just kind of gets old. People have been saying there's going to be a recession around the corner. They've been saying that for more than a year. And let's be mindful, if you think a recession's coming, what typically happens in a recession? Rates fall. The Fed is cutting rates during a recession is because the economy needs support. Now, a lot of economists don't think a recession is going to begin now until 2024 or later. But if you think that's where we're going, and that's typically what happens when you raise rates this much, we got to remember that rates typically fall during a recession.
Well, yeah. So this is actually interesting, and we could talk about this on the next segment. But the paradigm we've been in was a paradigm up until pretty much 2021. You could argue when it started, maybe it was during COVID, but we had a different paradigm, right? Times are good, keep rates low, things just keep going up. You know, if we go into recession, we just print money, we drop rates, do all that stuff. Right. However, it's an outstanding question of whether they're actually going to drop rates if we hit a recession, or if they're going to keep them high because they don't want inflation to come back. I mean, we had 9% inflation. They don't want that to come back, or 8.3. I forget the peak, but they don't want that to come back. But if you look at the 70s, that's what happened. Like they beat up inflation, and it came back. And Powell wants to be Volcker, not Burns. So,
right.
You know, the question is, you know, what are they actually going to do, right? Because if they're worried about inflation, and this was kind of like the last scenario that everyone thought would happen, but people were worried, like, all right, well, it's either we're going to have inflation, they're going to raise rates to fight inflation, or they keep the market going. But if they raise rates, it's going to cause a recession. Well, kind of did last year, kind of didn't. But now inflation's dropping. It could even hit zero by the end of the year. And but it's at 3%, and I don't know if it'll go below 2, but it'll probably go in the 2s for sure. And the market's still hot. So why are you going to drop rates? So, you know, it's this kind of chicken and egg. Like, what are you going to do if you keep rates high? That causes more problems and potentially more deflation. So it really kind of they get stuck in a rock and a hard place here with their balancing act. But I'm just curious in your thoughts, because it's I'm not sure there's an answer, but I'm curious, you know, from the real estate side, what you think.
Yeah, well, historically, once interest rates are hiked, it really takes 3 to 5 quarters for that to hit the economy. But they began raising rates in March of 2022. All right, well, we're going on 5 or 6 quarters now. But Americans, to what I had stated earlier, they do have more cash now. They do have more of an ability to be resilient. And one thing that helps the housing market is that not only do people have this cash, Americans with mortgages have record equity in their homes, $274,000. It's near record equity levels. That's really something that helps prevent any sort of delinquency downdrain or foreclosure downdrain like we saw in the GFC 15 years ago. I really don't think home prices are going to appreciate very much this year. The market is getting more used to absorbing these 7% mortgage rates. But here at Get Rich Education, we made our 2023 housing price forecast. And my forecast, this is on a national basis, is zero appreciation.
Well, it's optimistic. I mean, they went up 10% last year, and despite the rate rises. And I think the question, I guess the real question is at what point do they actually come into equilibrium? And you know, if you look at just looking at cash flow, and you mentioned that there is a lag, which there is, and you could argue it's 9 to 24 months, somewhere in that range. But the interesting thing is, so in 2021, you could have gotten a 2.5% 30-year mortgage pretty much towards the end of the year. You could have found those, like if you had a good credit and all that. So you have a $500,000 home at 2.5%. Now it's at 7.25%. National average. I mean, you know, different for different people, but 7.25%. 7.5 means your monthly payments have doubled. From 2.5 to 7.5 is a double of monthly payments. how do you square that? Where I get your point, where people have good jobs and they can pay, but doubling the monthly payment, that that's not a small change. That's like going to the grocery store and saying, "Oh, I'm going to go buy a carton of eggs." Oh, now it was $2, now it's $50. Like it's a huge difference. So how does that not impact the real estate prices, or are they just not reflecting because people just aren't selling?
Yeah, well, you bring up some good points because if the monthly payment, people buy more so based on a payment for their housing than they do on a price. So if their payment has nearly doubled in some of these cases, how do some people afford it? And the short story is it just goes back to economics 101 of supply and demand. We are so undersupplied for housing. People need to live somewhere. There's a shortage of homes both to buy and own and a shortage of homes to rent. Depending on the source you look at, and these stats are really all over the place, but it's somewhere between 1.5 million and 5 million homes short. So people cannot sit out the housing market. That's the short story. It's non-discretionary. People absolutely have to live somewhere. And home prices have risen faster than rents these past couple years. So with this affordability crunch, more people have to become renters, which is good for me. That's good for me because I'm a landlord. I want more rental demand. That is bad for real estate agents. There's a shortage of transactions with this dearth of supply. So it helps some people like me. I have high occupancy. People don't want to move. There's really not another place to move. And it's bad for people like real estate agents that are trying to sell homes to first-time home buyers. Within this housing shortage, it's the entry-level homes that make the best starter homes, where there's an even greater dearth of supply. So the effects are differential. Some people are hurt worse than others. And as a landlord, if I want to raise my rent, say from $1,600 up to $1,800, how do I do that if times are getting harder? How do I do that if a tenant is paying more for everyday staples at Trader Joe's or at Wegmans grocery store or for car gasoline? How can I possibly do that in a market like this? And really, it's because the market is not static. I can raise my rent from $1,600 up to $1,800 because I have greater expenses now as a landlord. How can I do that? Well, sometimes the renter can't pay that and they have to leave and they have to step down a class. Housing markets aren't static. So my new $1,800 renter, they might have stepped down from paying $2,500 somewhere. So there are winners and losers with this shakeup from high interest rates and high inflation. And those are just some of them.
So who are the winners and losers? Because I mean, the first time home buyers are basically getting the short end of the stick because they can't
Yes.
afford anything.
Yes.
And the high end, you can only downgrade so much. So that's obviously. But what do you think the winners and losers are of this kind of environment?
First time home buyers and real estate agents are real losers. I mean, there's others beyond this industry. The furniture industry, for example, has been impacted in some places because there just aren't enough new homes to move into. It's sort of sad, but homelessness is up. Most everyone sees that if they live in any city of an appreciable size. So the people on the lower rungs of society, amidst this paltry housing supply, they're the losers because just the very entry level housing is now out of reach for more and more people, and that's really sad when you have more vagrants in your hometown. At least based on what's visible, when I'm at a street intersection in my town, I sure see more homeless people too. They're really the losers. It's sad. So it's really sad. Here we are, the greatest nation in the world by so many measures, the biggest economy, the biggest military, the biggest brand, and we have trouble housing our own people. That's a real housing problem. Those are the real losers.
Yeah, no, I agree. I think I wonder if this goes on any longer, who else are going to be in that bucket, right? Because there's people on the margins for sure. But I guess I'm curious because if you think about everybody in an equilibrium, right? There's 10 houses and there's, 10 people, and there's the most expensive house and the least expensive house. If everybody goes down a notch, then you can't, right? There's not enough supply to accommodate. Like, people are going to go down. And this is where I get stuck, right? In terms of why aren't real estate going down? So if everybody says, let's say I've got 2 kids and I got a 4-bedroom house. Well, I can't go to a 2-bedroom house. I guess I can, but people won't, right? Unless it's desperate. So I'm still looking for a 4-bedroom house, maybe a 3, but ultimately everyone else is doing the same thing. So you're fighting, more people are fighting for the same house, which means you're really stuffing the low end of the curve. So the low end of the curve is getting higher and the high end of the curve is coming down because people just can't afford it. And so I get the short-term nature. People just don't sell. Like, oh, I can't get my price, I'm not going to sell. But if we have higher rates for longer, which is my thesis, we're going to have higher rates longer than most people think, eventually that catches up to the market and people have to find an equilibrium with pricing. I just don't see how it happens any other way. I mean, because your assumption you early made is we're going to have a booming economy and everyone's going to make more money, but the economics don't show that people are making a lot more money. You know, maybe a little bit, but real wages have not improved significantly over the last few decades.
Right. It's only a recent development that we've had 4% wage growth and 3% CPI growth. I mean, most people agree that the CPI is understated. So even now, I don't know that wage growth is truly exceeding the diminished purchasing power of the dollar. But back to what you had said earlier, and housing and its stable prices, and why are the prices stable? Why aren't they going up very much? It's an affordability constraint. And why aren't they going down very much? It's a supply constraint. That low supply keeps bidders on houses. So those are the constraints. Those are the bookends. Why home prices aren't rising much and aren't falling much.
So what's the outcome then? I mean, because it sounds like we're kind of in this sloppy middle, but what is the inevitable outcome? Like, who's going to win the battle?
If a recession really happens and really takes place, a lot of people have pushed that off to 2024 now. That typically corresponds with a lowering of interest rates, and that's going to help with affordability.
Yeah. I think that could be true. So you had mentioned once before, as we get close to wrapping it up here, you said the housing crash already occurred.
Right.
What's that all about? I didn't read it in the paper. It wasn't on CNBC.
Right.
What happened?
Right. What's that all about? Everyone missed the housing crash. Yeah, I've been known for saying that a housing crash is 100% certain. It's all over. And yeah, I'm talking about this era right here. The housing crash that occurred, the reason it's 100% certain and that it's all over is because it already happened. The housing crash is not a housing price crash. It's a housing supply crash, which is what has helped hedge us against a price crash, even amidst a doubling of mortgage rates. So Realtor.com reports the active listing count of available homes in America. And that count for many years up into and through 2016, 2017 has been 1.5 million available housing units for sale. But after the pandemic, in April of 2020, that's when the available supply of homes turned down and never rebounded. And in fact, it's about 600,000 available housing units are all that we have today per that metric. And there are a lot of ways to measure that. But we've had then from 1.5 million down to 600,000 available units. That is a 60% drop, a 60% crash, if you will. And really, to understand the profundity of that, the supply crash is worse than a price crash, leading to all kinds of problems, including homelessness, like I talked about here. So the crash already occurred. It's 100% certain because it has happened. It was a supply crash, not a price crash. That's what's hedged against a price crash. It was a supply crash. It happened about 3 years ago. And most economists don't predict that we're going to have an adequate balance of housing supply for the US population for a decade or more. It's inelastic to bring that supply of housing back up with demand, even though population growth has been pretty slow, we're just not building enough housing units. And there's a lot we can do to bring that up and ease regulations and train more people so that you actually have a young carpenter and a young contractor again that's able to do things. But there are a lot of reasons why we just can't build our way out of it anytime soon.
Yeah. Yeah. There's definitely there's basically a big hole in our economy that just keeps getting bigger. And as some of these challenges work themselves out, we'll see what ends up happening. But I totally agree with you. There's some dynamics here that are not going to be easily solved. I mean, I look at it and say, look, if you can't afford to live somewhere, move somewhere else. There's cheaper places to live, and you could easily build a home, one of there. But people don't want to live there. They still want to live in these high expensive cities that I don't. It doesn't make sense. But hey, Keith, I really appreciate you coming to the show and sharing your wisdom with us. For those of you who don't know Keith, I'm going to be on his show shortly. But
Yeah.
check out his show. So, Keith, where can people find more about you?
Oh, thanks so much. The Get Rich Education podcast, a weekly podcast, the Get Rich Education YouTube channel, or I built a free video course called Real Estate Pays 5 Ways. Most people don't understand those 5 simultaneous profit centers that I discussed before. You can get my free course right now, Real Estate Pays 5 Ways, at getricheducation.com/course.
Awesome. Well, Keith, once again, thanks for joining us. We'll have you back on in the future. This real estate challenge isn't going away, and love your perspective on this. So thanks again for joining us.
Oh, love the chat. Thank you, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, well, that was a great interview with Keith. Really appreciate him coming on the show. Always love our conversations, albeit they can be a bit spirited sometimes. I think he brings a good perspective on real estate that we certainly truly need nowadays in the real estate world. So now we're into the panel portion of the show. We have our very own Megan Gorman. Hey, Megan.
Hey, Kirk, how you doing today?
Doing great. And we also have our very own Barb Friedberg. Hey, Barb.
Good morning. Ready to talk real estate.
Awesome. We're all excited to talk about this. So Megan, let's start with you. What are some of your thoughts from the interview?
Yeah, I thought it was a really interesting interview. I sort of got a kick out of his story in the beginning where he talked about having a job and he would like his colleagues were interested in the fact that he was always going on vacation, and that even when he told them how he was making extra money, a lot of them didn't want to do that. And I thought that was an interesting story because it's actually good that not everybody wants to do that, right? I don't think it's a space for everybody, because it takes a certain type of investor mindset to succeed at it. And so I think it was an interesting story, but it also, I think, is fair that most people aren't suited for this. But the one thing that stuck out at me, and it was funny because when I was listening to this, my husband was walking through the room and he was like, well, he agreed completely with the comment, which was, he talked a lot about understanding location of your real estate. And I say this because I have a rental property in my hometown. And it's not something Barb or Kirk, you guys would want to invest in, because you don't know Southern New Jersey and Cape May, New Jersey like I do, right? I mean, I grew up there. I know how the season works. I'm a local, so I have all the relationships there. And so, you know, I do think what he said there was very, very important, which is you have to understand the location. And the last thing I'll say in that is, you know, if you aren't from a place, you don't live there, and you're trying to do it, you know, you really need to go spend time in the location to understand it. And I have a good friend, Lindsay, who has done a phenomenal job, even though we live in California, in buying rental properties in North Carolina. She's become quite the expert on a certain area in North Carolina, but she spent time there and built relationships and has come to learn the market, and has really put the time and effort there to become an expert on that space. So I did like his comments on location.
Good. That's great. And then Barb, what are some of your takeaways from the interview?
Real estate investing with hands-on, putting your money down, taking out a mortgage, finding the tenants, managing the property, whether you do it with a management company or not, is not passive investing. There is a whole host of responsibilities you have. First and foremost, choosing a property that's going to work. And I don't think we spend enough time on figuring out how to find a piece of real estate that is priced low enough that you can cover all of your expenses and get a cash flow, because that is not easy. There are periods when I have literally spent years, and my initial company, real estate company, was in Cincinnati, Ohio, which was one of the areas that our guests talked about. It's in middle America. It wasn't horribly expensive. And even there, it was very difficult to find properties that you could buy for a low enough price, take out a mortgage, and then have cash flow back. And so be aware that, it sounds super easy. It is not. And the area of the country where this is so difficult in places where the three of us live, which are the coasts and which are the most expensive locales in the country. Buying a 2-family in the Bay Area, if you think you're going to get a cash flow, even with rents in the stratosphere, you're dreaming.
Yeah, what are your thoughts, Megan? I mean, you also live in California, and I know numbers don't work in Massachusetts in most parts, but
Oh, you mean his whole duplex thing with 3.5 down?
yeah.
Yeah, it's frustrating. It is. I mean, it's frustrating. And I say this sitting in San Francisco. San Francisco right now, the condo market is a deal, right? It's probably the first time in a long time that this market has been soft. But I would tell you, I would never buy property here to use as an investment property, because being a landlord in San Francisco, none of the laws are in your favor, right? And I think that that's one of the things that people have to always think about when they're buying in a market, which is, what is the local landlord tenant law, right? How does it work? And who does it tend to favor? Because it's, in California, I have heard horror story after horror story where people have rented properties out and they cannot get the tenant out, and the tenant has more rights. And I think that that's one of those things it's really important to look at, to make sure you understand your rights and understand that if you are in that precarious position where you need to evict someone, how does the process work and how much will it likely cost you? because a lot of times you have to pay a person to go away.
Megan, hold
Yeah.
on. Megan, when you say it's a deal, really, you are speaking from California.
Yeah, I'm
Because
California jaded.
If
but
you
I also,
said
yeah.
a deal to someone living in middle America, when Megan says a deal, okay, guys, I just gotta say, as someone who grew up in the Midwest, a deal is not over $1 million for a 2-bedroom condo, okay? But
No, but you can get a condo right now in San Francisco for under $1 million. You can.
okay, that is not a deal to most people in the rest of the world.
Right. And
I mean, in the
I
rest
agree.
of the
I agree,
country.
Barb.
I know you
totally
do.
Yeah, and I'm not saying it. I want to make sure people are clear. Like, unfortunately, when you live in a certain area, your perspective gets skewed, and it's hard, right? Because, like, as an employer in an area like San Francisco, one of the biggest things I worry about is my employees being able to buy into the market. It's frustrating because it's something you have to worry about as an employer in terms of, will I be able to retain someone because they might never be able to buy a house here? It's frustrating. But to your point, it's not a cheap market in any way, shape, or form. And one of the things about these very expensive markets you have to keep in mind is, it's sort of weird because you have, some markets where a condo is an entry-level property to purchase, and you're up against other young buyers like yourself. Like, I remember when I bought my condo for the first time in Hoboken, it was clearly expensive as Hoboken, but I wasn't up against, 40, 50, 60, 70-year-olds. And what has happened in the marketplace today, and I know this because I help with this, is we have a lot of parents who help their children buy into markets and become competitive buyers, and it skews the marketplace, right? Because I do have people who are able to let their children at 25 years old buy a property at all cash because of how we've structured stuff behind the scenes. So that also skews property markets in these areas as well.
Yeah, it's interesting. I make 2 points that you guys made, and one is I had a friend of mine who I think it was about 5 years ago was looking at a job out in San Francisco, and it was a job. It was like, I think he was paying like 75 or 85,000 plus commissions, and he was looking around. He's like, I can't find a shack for that, like to live, not to buy, just to live, just to rent. He's like, I couldn't afford to live there, so I didn't take it, which is crazy to think about. That's you can't find anything, even in like the low rent district, like that's too much. And so I found that interesting. The other thing I want to mention is also the local landlord law. I live in the other coast, and I'm in a state where it's similar to California. I assume California was a little bit better because everyone who has you see these like fix and flip shows and all these shows, like there's so many real estate investors in California. It's crazy. Like if you go to the East Coast, especially in Boston, a lot of the stuff doesn't fly here. People aren't interested, like investing with their retirement account into real estate, like weird stuff like that. Like people are just like, it's weird. California, like, oh, let's do that. And I feel like there's a lot more people out there that are into creative real estate investing, but yet they can't afford it. And in Massachusetts, it's funny because it's well known that the landlord tenant laws are crazy in favor of the tenant, much like it is in California, the way you guys are describing it. In Massachusetts, I think the earliest you can get somebody out is 6 to 9 months. And if they're a professional tenant, you're looking at 18 to 24 months. And it's, you think about that and it's like, is it worth being a landlord? Because on top of that, you also have the cap ratios, which are crap. It's like 2 or 3. And I'd be looking for a 12. If I was to, rent a property out, I'd want a 12 for a cap rate, and so they're really low, and you're not getting your money's worth. So you have the risk of being a landlord, of not getting a tenant out. You've got low yield on the real estate, and prices are not coming down here yet, which is crazy. I mean, so trying to buy rental property and make it work. I think it was about maybe 15 years ago. I had a client who was started investing in real estate, and I was kind of going along with him with some of his stuff because I figured, maybe I can, learn something. And it was just curious in what he was doing because he was doing some interesting stuff. And I was talking to one of the guys that also an investor, and he's been doing it for so long that he was a part of like the old school Carlton Sheets kind of guys, and that's sort of like midnight, 2 a.m, infomercial people. They're selling how to invest in real estate people. Like I met some of those guys and they're like, and I guess one of the guys did a deal and he said, I guarantee you that I can allow you to buy houses with no money down anywhere in the country. And this guy's in Massachusetts. He's like, sure, you try it. And he couldn't make it happen in Massachusetts. Like Massachusetts is so weird when real estate laws. But I just find it interesting that in many parts of the country, in middle America, the numbers actually are okay right now. But if you look in the coast, I don't know how people buy investment property in the coast because the numbers just don't work. I mean, we looked at a few websites, Doug and I on the Friday show, we bring it up every once in a while, but the numbers are still crazy.
Well, that's the inventory shortage we're having, right? I mean, no, there's just
because
not
no
enough
one's
houses
listing,
on the market.
but no one's
Pardon?
listing their properties. There's 600,000 more realtors than there are properties on the market right now. There are no properties being listed because people don't want to move. If they move to anything else, they're going to be paying more. So they just, instead of moving to get a better kitchen, they just reno the existing house for a better kitchen because it's going to cost them twice as much to move. I mean, that's why there's low inventory. Nobody's selling because they can't move. It's crazy. I mean, you know, that's not the whole thing. Obviously, it's part of it, but the number, I just don't. I'm just struggling with this for like the last few months. Like, how's the real estate market going to find an equilibrium? Because you can't sell because it's going to be more expensive to buy something else. You got to stay there. Some people do have to move, so they're going to end up getting the short end of the stick. People who are first-time home buyers can't afford anything. I mean, this market is so crazy, and in this supply and demand thing, people are still talking about it. Just, I get it, but at some point things have to move. So what's going to cause that? I don't know. Maybe Barb's got some thoughts, but
Barb does, but
okay.
They're not really happy thoughts because, like all economies, the financial economy, the real estate economy, they go through booms and busts. And even now, even with the interest rates tripling for mortgages over the past year, the commensurate drop in prices has not occurred. But this doesn't go on forever. There will be a period of time. Like, look at 2008. Obviously, we had a huge economic crash, real estate crash because of the debt crisis and the recession. And during those periods, even on the coast, will be able to get good priced real estate. Like you said, Kirk, middle America, the numbers are totally different. It's almost like you're talking about different worlds when you look at middle America, Southern America versus the East and West coasts. And so you want to be a real estate investor, you really have to understand the mechanics and how much you're going to have to pay, how much your carrying costs are for the property, the amount of reserve you need for vacancies, because in most markets, you're going to have periodic vacancies and your costs will not take a vacation. And then factor in the percentage return that you expect to get over the top of all of your expenses, planned out conservatively. Forget no money down. I think that's a ploy. If it works, I don't know anyone or have seen anyone that really comes out ahead on that. You need some capital to invest in real estate. That's just a reality. And I think who's making it work on the coast? Probably big corporations that don't need the cash flow and can just buy up real estate and wait on the appreciation.
But isn't that assuming that you're going to have appreciation? I mean, if you can't make the numbers work, where's the appreciation come in?
You know, Kirk, I remember 30 years ago, an acquaintance was living in Southern California, and he's like, I am buying a house on Venice Beach for $300,000. And we were like, oh my God, that is so much money. I can't. And this is when you could buy a house in Ohio for $75,000. You know, how can you spend that amount of money? imagine if he still had that house for $300,000, what it would be worth now. Probably $5 million. So yeah, over the long term on the coast, the probability is very great you will have the appreciation. But as a regular investor, a regular individual, if you're buying a property, counting on appreciation, and you have no cash flow, and likely you will be paying out every month to cover your costs, that doesn't make sense. That doesn't qualify as a good investment.
I think you made a great point there, Barb, which is, if you're buying for appreciation, you have to be able to sustain that property for the next 10 years or however long it takes to appreciate. Because let's just say hypothetically there's no appreciation for the next 10 years, right? You still got,
which is possible. That
right.
happens for sure.
Yeah, it happens. I mean, look at Japan. Property prices went down for 20 years, slowly, like a few percentage a year, but it happened. And, it's coming back. But if you wanted to flip a property in 5 years, you might be disappointed. So cash flow, I think is the answer.
Cash flow is really important. And also the idea of buying up fixer. When our guest mentioned, well, I buy turnkey properties, what went through my mind is, well, if you're buying a turnkey property, you're not getting a bargain. And it is, in most markets, it is really hard to make a return on your investment above your expenses with a turnkey property. The strategy of buying a house that needs work or a small 2-4 family that needs work, then you can get a bargain. Your likelihood of getting a bargain is much, much greater. And having to put in the sweat equity, fix it up, bring the apartment up to a better state, and then get the higher rent based on the better quality property, that can work in some areas of the country for sure.
Yeah, I think it's a good point to put things in perspective. So Megan, I want to we talked about it before the show, 1031 exchanges. Let's talk about that really briefly, because I think that's a great tool.
Oh my God, this is like people's favorite question. And it's funny. I think in concept, 1031 exchanges are great. They're a lot harder to do than you think. So a 1031 exchange really is an exchange of a like-kind property for another like-kind property. So what I mean is, if you have a business property or an investment property, rather than sell the property and be forced to recognize capital gain, recapture depreciation, you are allowed to swap the property for another property, which allows you to defer the capital gains and the depreciation recapture. You don't lose those, they just move to the next property. However, there are certain parameters that you have to follow. The first is you have to find the property you're exchanging for 45 days. You have 45 days to find that property, and you have 180 days to complete the exchange. So there's a timing element, and typically people will use a 1031 service or a straw man in order to have that happen. The other thing to keep in mind is sometimes it's not easy to find a property at the same price. So if you if you exchange a $500,000 property for a property that's $450,000, that excess $50,000 is boot in the tax world, which means it must be recognized. The other question I get a lot is, well, can I just exchange this rental property I have and buy this property I want to have because I want to live in the other property? Sure, but here's the parameters. The IRS has a rule that it must be like kind a year going into the exchange and a year coming out of the exchange. And they can audit and look at that. So you have to make sure that you're complying with that. And then the last thing I'll say is, once you do the exchange, you always have to keep up all of the depreciation schedules, right? It doesn't mean it all disappears. And states like California have gotten very wise to 1031 exchanges, right? You have people who are in California who say, ooh, I'm going to 1031 exchange my rental property for a rental property in the great state of Nevada, right? And California's tax rates are 9.3 to 13.3%, and Nevada is 0. California says, no, no, no. If you do a 1031 and you exchange for a property out of state, we have a form that we're going to require you to file every year with us because we're going to track that property, because when you eventually sell it, we want our money. So it's a great concept. It does work, but you must be aware of all the sensitivities around it to execute on it where it would not generate IRS scrutiny. So I hope I've explained that decently.
Yeah, you did a great job, Megan. The biggest takeaway I took away from this conversation today is don't invest in California.
Exactly. Well, you know what? If you're going to make it your primary residence and you can find great locations, totally, right? If someone's going to gift you a beach house in Santa Barbara, you do it, okay? Right? And if it's a gift, it's even better, right? But yeah, California's tricky on a lot of stuff.
I like gifts, Megan. My birthday's coming up, so if you're looking for things to get me, that's on my list.
Of course, a beach house in Santa Barbara, I'm on it. So.
Oh, good. All right. Well, let's wrap it up here. So, Barb, final thoughts from you.
Yes. Final thoughts. Management of your rental real estate. Okay. Any way you slice it, it's a lot of work. You do it yourself. You're getting the call in that middle of the night, the pipe burst, or you're getting the cat that peed all over the carpet before the tenants moved. Okay. You hire a management company. They're not going to manage it like you are. So you have to keep on top of them. So I'm not saying don't do rental real estate. I'm saying go in with your eyes open. Do not believe anyone that says it's passive and a piece of cake. I'm Barbara Friedberg. You can find me online and at my website, Barbara Friedberg, Personal Finance.
Thanks for coming on, Barb. And Megan, final thoughts from you.
Yeah, I mean, I think that, at the end of the day, we talked a little bit about 1031 exchanges. If you're going to go into this market, learn the tax rules around it, because one of the things that struck me in the conversation is he was very clear. He understood all of the tax implications and how to document and do it the right way. So if you're going to go down this path, make sure you find a good accountant, a good CPA, a good EA to work with you. So I'm Megan Gorman. You can find me on Instagram at All the President's Money. Kirk, thanks for having me on.
Thanks for coming on, Megan.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.